Can you hear me? This mic is a little tricky. Can you hear me with the mic? Yeah. Mic is a little tricky because until I get the microphone in the right place, you can't hear me. But first, you got to stop talking, otherwise, you can't hear me at all. Couple of things before we start. One is, if you're not getting any emails yet, make sure you get your Stern email. I know I said this last session, but I just want to make sure that it gets said again. If you're not getting emails, make sure you find out what your Stern email address is. You will need it for a lot of stuff in this class, including accessing data, getting on the Google shared spreadsheet. So basically, make sure you get your Stern email. Second is, I did get a question about the valuation of the week, whether I was going to talk about what's happened so far, because the Google shared spreadsheet, there are quite a few valuations already on there. Let me tell you upfront, I will not talk about the valuation of the week in class. That's not the point of the valuation of the week, because what am I going to say, right? Essentially, the valuation of the week, I tell you what I think about the company, what my story is, and my valuation is. And then you tell your story and your valuation. There's no real conversation to be had other than, hey, your story can be different from mine, your value can be different. And the only thing you take away from it is just because you have the same shared facts doesn't mean you come up with the same value for the company. And one of the things we're going to start talking about today is why, if we all have the same data, do we come up with different judgments of value? How do we know who's right or who's wrong, or do we not know at all? So today's session, as I said, every session, we're going to start with the start of the class test. Today's session, I want to start with what I think is the biggest single enemy of good valuation, and it's bias, preconceptions. How many of you have already picked a company to value? Nobody's picked a company yet? No, I haven't even told you to pick a company. Say what company, okay? But each of you over the next week will be picking a company. I'm going to describe the project. You're going to pick a company and you're going to value that company over the course of this semester. I'm going to argue that even before you sit down to value the company, many of you have already made up your minds on what you think this company is going to look like at the end. You prejudge the company. Why? Because you don't walk into a valuation with a blank slate. Let's talk about all of the different places that bias comes from. The first is that if you're looking at a company like NVIDIA, Somebody remind me what NVIDIA's been doing for the last 2 years.
Going on.
It started it's going up, is actually, it's going up like a rocket. Start of the year in 2023, it was at $200 per share. Now it's trading at $600 per share. When you sit down to value NVIDIA, let's say that's a company you've chosen to value. What do you see out there? Everybody's so excited about the company, they're pushing it up. That's going to affect what you come up with as a value. Because if you come up with a company being overvalued, it's almost like you're saying, I'm right, the entire crowd is wrong, and that's kind of tough to do as a human being, herd behavior. The second is we look back at things and we always think that, we would have done things differently with the hindsight, with the benefit of hindsight. So the end of 2020, you'd have said, look, I would never have invested in a hotel company because I knew COVID was coming. Even though you did, that's hindsight bias. It's common in valuations bias. There's also the power of suggestion. How many of you watch CNBC? Okay. How many of you like Jim Cramer? You don't have to be shy about it. It's fine. He's a celebrity. But let's say you like Jim Cramer and the company you pick is the company that he yelled out should be a buy. He never mentions it, he just yells it out, was a buy last week. Could that affect what you find? Yes, because somebody you liked and respected said this company is undervalued, it is going to find its way into your consciousness. But here's the biggest reason there's bias. I don't do valuation for a living, thank God for that. Many of you will have jobs where you have to do valuation for a living, which means somebody is paying you to do the valuation. Remember the old saying, he who pays the piper calls the tune. Very true in valuation. One of the things we're going to talk about is how the fact that you are paid and how much you get paid will be determined by which direction your valuation goes is going to affect your valuation. So let's start this with a series of very, very simple tests. I know you haven't done, intrinsic valuation in detail. Just go with your gut on each of these questions. You started a business. It's a new thing to do, right? Everybody wants to be an entrepreneur. Everybody wants a startup. You have a startup. And one of the things you decide to do is you decide to value your business. And I'm a venture capitalist. You value your business because you want to come to me for some capital. Why do you need a value for your business? Well, how does venture capital work? When you come in and ask me for money and I give you money, what do you give up in return? A share of your business. So in order to decide what share to give up, you got to value your business. So if you're valuing your own business, and with each of these questions, all I'm asking you is, are you going to be biased up in terms of getting a higher value, biased down, or no bias at all? So in the case of valuing your own business, what's your bias going to be? Up, right? You're going to tell me your business is worth $10 billion, $100 billion, 1,000 billion, 10 trillion, whatever it is. But if I'm the venture capitalist looking at your business, what's my incentive? What is it?
Give a low value.
Give a low value because I get a bigger share of your business. You got all guys have all watched Shark Tank, right? This plays out on every single Shark Tank pitch. I say my business is worth 10 billion. Kevin says, no, you're worth nothing. And then somewhere you end up at like 3 million or 4 million in the middle. But you can already see that there's bias here because of which side of the table you're sitting. Everybody comfortable with that? Let's move on to a second one. Let's assume that you got married and you are now getting divorced. You started a business and now you're valuing your business because you got to split your assets. You live in a community property state where everything's got to be split 50-50. You're valuing a business because you now have to pay your soon-to-be ex-spouse half the value of your business. Help me out here. Are you going to come up with a really high value for your business or a really low value for your business? You're going to say the business is worth nothing. There's this Texas oil billionaire called Henry Ham, who had exactly the scenario. And he went to court and said, I'm a terrible manager. I'm going to ruin the business. It's worth nothing. Half of nothing is nothing. So I'll give you nothing. It didn't quite work out, but you can see the bias there is you want to come up with a low number. Let's say you're an appraiser for an owner who is valuing the business for tax purposes. In other words, this is now going to be taxed based on whatever value you come up with. See the bias there, right? You're the appraiser for the business, you assess value, you want to come up with as low a number as possible because you want to pay less taxes. But if you work for the IRS, you'll have the exact opposite incentive, right? You want to come up with a higher number. We think of valuation as numbers and objective, but the truth is the game is set right at the beginning when you think about who you work for and what your end game is. Now let's move on to equity research. Does everybody know how equity research is structured? There's sell-side equity research and buy-side equity research. What's the difference? Anybody want to explain the difference between the two? What's sell-side?
So, sell side is like you, sell the reports to investors and then,
Not at what price?
sorry,
You said sell. Usually selling requires that you get paid. How much do you get paid?
like per report.
Nothing. You get paid nothing. Sell-side equity research, you give your research away to clients. Clients will be portfolio managers. So you say, that's very Mother Teresa-like. But what do you hope to get back in return? You work for Morgan Stanley or Goldman Sachs, you're a sell-side equity research analyst. You give your research away to those clients. You're hoping that they direct the trading through your clients. So essentially it's the weakest link in sell-side equity research. It's not a standalone money-making business. It's like a service you give away for free, hoping you get something back in return. So that's sell-side equity research. You work for Goldman Sachs. So most of the equity research analysts you see on CNBC are sell-side equity research analysts. They work for investment banks. They turn out equity research. Their clients are essentially portfolio managers who don't have to listen to them, but might read them. What's buy-side equity research? Yes.
Either in terms of what their research needs or this separate research offset to apply separately.
So you go to work for Fidelity as an equity research analyst. You do research on companies. Your research is entirely for internal consumption. Portfolio managers within Fidelity decide what to buy or sell based upon your research. So sell side and buy side. So let's say you're a sell side equity research analyst valuing a company. I'm going to, in this class, I'm going to argue that sell-side equity research analysts never value things, they price it, but let's use the word value. Is there any bias that you see in this process? I mean, what might cause bias in the process?
So you have like an incentive to rate it a buy because you don't want to lose corporate access.
Okay, so did everybody get what he said? There will be an incentive to come up with a higher value and rate it a buy. Because the way sell-side equity research is structured, and this again is another weakness of sell-side equity research, is if you become a sell-side equity research analyst, you're given a group of companies to follow, especially retail, 20 companies, and you will track them for the rest of your life. Leave that depressing thought kind of hanging out there, but these 20 companies now become your entire existence. You think, so what? You put a buy recommendation, they love you. You put a sell recommendation, they don't like you. You say, who cares whether they like me or not? As a sell-side equity research analyst, I know there are lots of SEC rules on what companies can reveal. Your existence rests on getting information from these companies. It doesn't have to be specific information. That's probably illegal, but kind of hints on what's coming. Our inventory is running low. You read into the rest. The minute you put a sell recommendation a company, that access gets cut. Do you know what the ratio of buy to sell recommendations is on Wall Street? It's 8 to 10 buys for every sell. That used to be 25 buys to every sell. So at least we're moving in the right direction. There are far more buys than sells. And Wall Street has created these very, very queasy words for describing when they want you to sell. They have things like strong buy, weak buy, really weak buy. I don't even know what a weak buy is. How does that work? You get on Schwab, you pick a stock, and then you hit the buy button really softly. That's a weak buy. If you hit it hard, it's you either buy or sell, right? But the reason they do it is a stock that's brought from a strong buy to a weak buy. The analyst saying, sell, I can't say the word, but sell, that's what I mean. Some sell-side equity research houses use numbers, 1 through 5. We've lowered the stock from a 1 to a 2. What does that even mean? Sell. That's what it means. But you can already see the bias in sell-side equity research is to come up with too high a growth rate, too much of a value, because it's access to these companies. That shouldn't be true for buy-side analysts, right? Buy-side analysts, though, don't answer to companies, they answer to their portfolio managers. So let's say I'm a portfolio manager. I call you and say, look, I own 1 million shares of NVIDIA. I love the company. I would like you to do research and tell me whether I should keep the company. Now you can come back with one of two answers. NVIDIA is amazing, in which case I say, I knew that. This is amazing. This is good. You're a great analyst. Or you can say NVIDIA is not that good a stock, in which case, I mean, you might have done the right work, but your portfolio manager, there's a tendency to reinforce whatever your portfolio manager's already decided to do. So if you bought a stock, they're going to reinforce it by saying the stock is undervalued. If you sell short on a stock, they're going to come back and say, amazing job. I mean, nobody ends up in a good place when you contest the king. And essentially, if you're reporting to a portfolio manager, that drives what you end up finding. And finally, let's talk about M&A, the most screwed up and biased place in all of business. So you know how M&A works, right? You guys be an acquiring company. You're thinking about buying a target company. Let's make it a friendly merger. What's a friendly merger? Well, then nobody's, both the acquiring company and the target company want the deal to go through. Here's where it gets tricky. The acquiring company goes out and hires a banker. You guys are going to be bankers to the acquiring company. The target company goes out and hires its own bankers. Hopefully not the same banker. That would be a little conflict of interest. There are 4 people in this room now. The acquiring company CEO, the target company CEO, the acquiring company's investment banker, the target company's investment banker. What's their shared objective? They want the deal done. Why? Because it lets the acquiring company have the ego. We did an acquisition. The target company is saying, amazing, we sold our company for 20% more than the price. What do the bankers get out of the deal? Deal fees, right? Who in that room wants to speak the truth? Have you ever seen the Few Good Men with Jack Nicholson? If you get a chance, go on Google, type in Few Good Men, Jack Nicholson. It's the last scene in the movie, or towards the last scene. He's in court, he's in the dock, and I think it's Tom Cruise is the lawyer, and he's faced with this mountain of evidence that he's been lying all along. And one of my favorite lines in the movie, Jack Nicholson says, you cannot handle the truth. So you really don't want to know the truth. And that, in fact, is what happens in banking. Nobody wants the truth. Everybody wants to grease the skids in a friendly merger. Everybody wants to make the deal look good. So here's what will happen. The acquiring companies, bankers, will tell the acquiring company shareholders they're getting a great deal. What does that mean? That they're actually paying less than the value of the company. The target company shareholders pull off an incredible trick. They go to their shareholders and tell them they're also getting a deal. And what's a good deal for a target company shareholders? They're paid more than the value. In other words, they're delivering contradictory answers, and both are doing it with exactly the same spreadsheet, often the same background, the same models. So how do they pull it off? Now do you see why synergy and control show up in these match? Because with synergy, both sides can do this and get away with it. Incredibly biased process. Asking a banker whether a deal makes sense is like asking a plastic surgeon whether there's something wrong with your face. What kind of answer are you going to get? You're amazing already. I mean, my job as a plastic surgeon is to find something wrong with you. Your nose looks too big. Your cheeks look too fat. Your lips look too thin. I'll find something that I can fix. But you can't blame me for doing it. That is my job. When you have a hostile acquisition, what changes? Got an acquiring company, got a target company, got 2 bankers. What's different about a hostile acquisition? Yes.
Target shareholders.
Not the target. The shareholders are never in this game, right? It's always the managers, but the target managers don't want this deal to go through. So if you're the banker or the acquiring firm, you got to be very careful about the message you deliver to your shareholders, because if you tell them they're getting a great deal, that will be used as ammunition by the bankers on the other side saying, if they're getting a great deal, we're getting a horrible deal. Things get really tricky, but again, it's incentives that drive this. So you got to be able to say, well, we're actually overpaying, but that's okay because there's this magic that'll happen. Again, synergy helps you. And with the target company, again, you're going to be able to fight the deal, push up the price by using a variant of the same argument. The bottom line is bias is everywhere. So what can we do about it? Be honest with ourselves about it. I think what's missing here, and this is my issue with all the alphabet soup of appraisal certifications you have now. CFA, ASA, I don't have any of them, but I've seen all of the literature that comes out of them. They all claim to be objective. They all claim to be scientific. And my reaction is, please stop lying. Face up to the truth. Because then we can talk about how to deal with bias. You can't make it go away. We're human beings. Bias is embedded in the system. All you can do is be aware of it. Because if you're aware of it, at least you can make decisions that capture the bias. So we'll talk more about bias, but I'm going to, all of these, the start of the class test will be on the webpage with the lecture notes. You found the page, right? No, I've sent it several times. It'll be the first thing for the class. You can download the questions. You can also download the answers. But let me go back. I'm sorry, I have to keep switching slides because for whatever reason, if I don't do it, Zoom will leave it on those old slides. And I know it from hard experience now. So let's talk a little bit about the project. I mentioned what the project is, but I want to give you a little more substance on what this project is. Your project started on Monday. You didn't even know. Your first job is to find a group. That group, if you've read the project description, can be up to 8, but it has to be at least 4. So there's got to be a critical mass. The reason I say up to 8 is the logistics of larger and larger groups get trickier for you. And if you can handle it, I'm okay with it. So if you have 8 people in your group, now remember, getting all 8 together is a little more difficult, but 4 to 8. Here's what you're going to be doing. It is a group project, but each of you individually will pick a company. So let me be explicit. If you have 4 people in a group, you will have 4 companies. If you have 6 people in a group, you'll have 6 companies. If you have 8 people in a group, you'll have 8. So having a bigger group doesn't reduce work. It'll just be more companies. Okay. The project has 2 parts to it. There will be an intrinsic valuation / discounted cash flow valuation. That part, you have a chance to get feedback midway through the semester. I do this for 2 reasons. One is to actually give you feedback. The other is to actually get you to get the intrinsic valuation done. So March 29th, which is a Friday, at 5 o'clock, I'll create a separate, folder in my mailbox for just these. And I will try to get them back to you as soon as I can. It'll be sooner than you think. And the feedback will not take the form of a grade. It'll just basically go through your evaluation, say, this growth looks high for this company, or this cash flow looks negative for too long. Essentially, suggestions that you don't have to take. Now you say, what if I don't turn in my spreadsheet for feedback? No penalty. But then if you really, really screw up and you turn in that screwed up valuation at the end, you can't blame me. I mean, you didn't even get a chance to fix it somewhere. The final project is due on May 6th, which is the last day of class, at 5 p.m., which is the class ends. So presumably you'll have the project written and done before you come to class, because you will clearly not have enough time to do it in the 15 minutes after class. Now, in terms of picking the companies,
Each of you has to pick a company, but I'm going to put an overall constraint on what these companies have to be. Because as I said, valuation is easy. If you pick nice money-making companies with long histories, if each of you picks a company like a Coca-Cola, there's not much you can learn in this process. Each of you can pick whatever company you want, whatever part of the world. You can even pick a private business if you choose to. But that company has to have at least a year, hopefully 2 years of financials. You don't need 50 years of financials. It can be money making or money losing, it doesn't matter. But here are the constraints. At least one of your companies has to be a money losing company.
That will be difficult to find. What percentage of US companies lost money last year? 56% of US companies are money losing. You'll have no trouble finding a money losing company. Okay, so if you come to me and say, I can't find a money losing company, you'll have serious doubts about your research capabilities. At least one of your companies is to be money losing. That money, it could be a company that's never made money. That's okay too. After all, we have to be able to value those companies, but at least one of those companies will be money losing. At least one of these companies should be high growth in revenues, not in earnings, because otherwise you'll be avoiding startups. High growth company. At least one of your companies has to be a non-US company. And I'd prefer that you do your valuation in the local currency. If you pick an Indonesian company, I'd like you to value a company in Indonesian rupiah. Why? Because I want you to get comfortable. And we'll talk about the tools you will need to be able to do it. I want you to value a company. There are some odd ducks out there, right? You take an Alibaba for the longest time. It was incorporated in the Cayman Islands and traded in New York, but it's a Chinese company. If you pick Alibaba, I would treat it as a foreign company. And now, of course, it's a Hong Kong listing, so you don't have the same issues you did a couple of years ago. But at least one non-US company, preferably the local currency. And the fourth, you can even take out. Most companies now, the word is service companies, retail companies. So in a sense, I've added a software because in the old days, there were a lot of manufacturing companies and everybody picked a manufacturing company. I don't even think this is going to be an issue. And you say, but those are 4 constraints you put in. Remember, one company can meet all 4, right? You pick up. Here's a suggestion. You're a group of 4, a 5th person wants to join in. You can extract a bargain. Make them value the high growth, money losing foreign company, and you got all of the requirements out of the way. But remember, the end game here is not to pick a company that is easy to value, which will give you the more trouble you have in your valuation, the more uncertainty you face, the more you will learn. I will leave that choice up to you. And you can pick Con Ed and you'll be done in 3 days, but you will learn absolutely nothing about valuation. So each of you will do the valuation of your company. The group has to put together the final project. There's very little group work, and I've done that intentionally because I know how much you hate each other by this point in time in the program, but too much group work. But there'll be 1 grade for the whole group. And what I'm throwing in is an incentive to pull up the weakest people in your group as you go along. Because there will be people who will be lagging, and you got to figure out ways to make them come up. And watch The Godfather a couple of times, some good suggestions on how to get people to do things that just don't want to do. Pets, head of the pet on the bed, has amazing tricks. You have no idea what I'm talking about. You haven't seen The Godfather, but so here's what you're going to be doing with the company. First, you're going to do an intrinsic valuation, a discounted cash flow valuation, with all of its components, story, numbers, valuation. I will supply the tool. In fact, I would prefer that you don't build your own spreadsheets, because then you'll be spending much of the semester learning Excel. And let's face it, that's not why you're in this class. So I'll supply the architecture for doing the valuation, but you have to do the story, converting to inputs. The dirty work of valuation is still yours. And that's the part that you're going to get midway through for feedback. Second, you're going to price your company. I said value relative to other companies, you're going to price your company. What does that involve? Well, let's say you're looking at Microsoft. The first part will be an intrinsic valuation of Microsoft. And the second part, you're going to price Microsoft relative to other software companies.
And already see that, you can see there's a component of discretion here, what software companies, big, you might decide that Microsoft should be compared to other of the FANG stocks. Because there's really no company like it, but pricing is all about making judgments about metrics and comparables. I'm also going to ask you to price your company relative to the whole market. For the moment, that's going to sound mysterious. What's the difference between part 3 and part 4? Part 3, I'm asking you to compare a software company to other software companies. In part 4, I'm asking you to price your company relative to how the market is pricing all other companies. Towards the end of the class, and you saw this in the syllabus, we're going to talk about using option pricing. In some company valuations, option pricing can help you augment your valuation, add on to it. A small biotech company, an oil company, maybe 1 out of 6 or 7 companies. But if your company happens to be one of those companies, I want you to apply an option pricing model to augment your valuation. So at this stage, think of what you'll have. You'll have a discounted cash flow value for your company, which would be a number. You'll have a pricing for your company against a sector, another number. A pricing for your company against a market, a third number. And a pricing with option pricing thrown in, which would be a 4th number. Will the 4 numbers be the same? No, there'll be 4 different numbers. So here's the last part, and I want you to think about this at your end mission. This is not an exercise in playing with numbers. This is about you making a decision based on your valuation. So after you've done your valuation, your pricing, your option application, you have a singular mission. Tell me whether you buy the stock or sell the stock. No strong buy, weak buy, semi-weak buy, kind of feel like selling, don't feel, no, you buy or sell. I will leave the hold option for those of you who are truly chicken. You might as well just put chicken in there, I don't care, you know. Every semester I try to make this go towards 0, but for a few of you, your value might be so close to the price that hold is in fact the choice. But this is the end game. The end game is not to churn out a value, but to churn out something you can take an action on. And I want you to pull the trigger on that action on May 6th. Your valuation will be as of May 6th. Which means it's this upbuilding you'll do along the way. But the basic building up basically will be over the next few weeks. And that's the timeline. So it's put in the calendar so you can see what you need to be doing. As I said, none of you is going to keep my timeline. I'm a realist on this. Maybe a few type A personalities. But I'm going to prod you every Thursday when I send you the project email. I'll put an arrow next to where you're supposed to be. And say, and I let you put the arrow in where you are and figure out when that gap becomes untenable for you. Okay? Any questions on the project? Yes, go ahead.
So during the lectures, like throughout the semester, are you gonna be like commenting on the project?
No, but I'm going to be commenting on estimating a beta. Estimate everything that I do in the class is commenting on the project, right?
Yeah.
I can't comment on an individual company. Each of you will then relate. And you know what? When we talk about beta, if you're keeping up in your project and you want to ask me about something you found in your company that makes a difference, by all means, bring it up. That's one of the advantages of staying on top of the project. Is then you're perfectly on it's fine to bring up your company and say, this is what I found for my company. What do I do? Yes.
Put an ideal investor time horizon or just.
No, this is just you, right? Decide for yourself because there is no ideal that cuts across. So if your time horizon is 3 months, that's fine. Okay? It's your money. You're not advising me, right? Okay, folks. Yes. The question that was asked was something that I would have come to later in this session anyway. The question was, do you need a 3-statement model? Clarify, what are the 3 statements again?
So income, balance sheet, and.
How many items are in those 3 statements put together?
Like the total line numbers? I mean, it depends on how much you want to.
Lots and lots. Let's say lots and lots is a good description. How many of those line items you actually use in evaluation? Probably 6 or 7.
Yeah.
What the heck are you doing forecasting the rest? The reason he asked is this is Wall Street religion. You know why? Because they like to bury you in detail because you don't see the crack. That's really the bottom line. It's one of the most absolutely useless exercises in valuation. It actually, I'll give you the personal story here. My youngest son graduated 2 years ago, but in his junior year, he got a job at a hedge fund and he calls me in the middle of the summer asking for advice, which he never does. This is shocking that he asked me for advice. So he said, look, I've been asked to do a 3-statement forecast by my managing director. What should I do? And I said, I would tell you if I knew. He said, you do valuation, right? Yeah, I said in 40 years of valuation, I've never once had to forecast out all 3 financial statements. It's an exercise in accounting torture. It's not an exercise that helps you in valuation. So the long answer to your question is, no, do whatever you need to do to come up with the value. This is not about satisfying, it's about satisfying yourself. Because remember, you're going to act on that value. Go as deep as you need to, or as shallow as you need to make that judgment. So let's talk about valuation. As I said, I've been teaching this class for almost 40 years now. And I'm often asked why I teach this class. So part of the reason is, no, I need to, it's my teaching. I need to get something taught and this might as well. But why bother? Because the truth is most people don't believe in valuation. Including most people who do valuation for a living. They do it because it's their job. They do it to cover their rear ends. They do it because everybody else does it, but they don't have a reason for doing it. So I'm going to start with the answer to the question, why do I do valuation? I do valuation to fight the lemming. You heard of lemmings? Lemmings became famous or infamous in the 1950s. There's mixed stories about how it happened. Was it a Disney movie or a National Geographic, documentary? And lemmings are these big, ugly, rat-like creatures. So in this documentary, thousands of big, ugly, rat-like creatures. So don't glamorize them. They're not cute little bunnies. They're just ugly, rat-like creatures. Ran right off a cliff into an ocean and committed collective suicide. And ever since, one of the big questions has been, why did they do it? What drives them off the cliff? I don't know the answer to the question, but let's do some virtual imagery. You can see why the first lemming did it, right? He was going too fast. He couldn't stop. He slipped off the cliff. Goes right into the ocean. Incidentally, these guys can't swim, which kind of seals the deal. Dead. Second guy, too close to the first guy. But I'd like you to put yourself in the shoes of the very last lemming in the group. I know lemmings don't wear shoes, but kind of hang in there. Anyway. So you're with me? You're the very last lemming. You're running towards a cliff. You've seen your entire tribe disappear off that cliff. I would assume you had second thoughts about what you were just planning to do. Your left brain, right brain, whatever parts rational, stop, 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 don't do it. And then you hear this voice in the back of your head. You know what it says? They must know something that I don't. Remember those 7 words, the 7 most deadly words in investing in valuation. They must know something. You'll hear it. You know when you hear it? After you valued your company and come up with the value differently. I heard it last year during the summer when I valued NVIDIA at $240 per share. The stock was at $480. My first reaction is they must know something that I don't. And when you hear that voice, magical things will start to happen in your valuation. Your growth rates will start to creep up. Your discount rates will start to go down. Your value will go from 240 to 260 to 280 to 300. And if you don't stop, you're going to end up at 480 like everybody else. In fact, you can divide the whole world of investors into 3 groups of lemmings. The first group I call proud lemmings. I'm a lemming and I'm proud to be a lemming. They call themselves momentum investors. But what do they do? What do momentum investors do? I'm a momentum. You know what a momentum investor does? They look for a crowd and they join in. You're buying, I'm buying too. Why are you buying? I don't care. A lot of you are buying, I'm buying too. Proud lemmings. They don't even hide it. The second group I call Yogi Bear lemmings. When I was growing up, I used to read these Yogi Bear comics. Yogi Bear is, of course, a bear in Yellowstone Park, I think, smarter than the average bear. Yogi Bear lemmings are smarter than the average lemming. You know what they want to do? They want to run with the crowd to the very edge of the cliff and at the last moment veer away. Admit it, you're tempted, you say. That looks great. I get all the upside of momentum, none of the downside. I'm smarter than this average investor, the average lemming. I can't pull off being a proud lemming. I am not smarter than the average lemming. I don't know where the cliff is coming. Notice after every market correction, people get on CNBC, I saw this coming. How come you never mentioned you were on every week for the last 2 years? After the fact, everybody saw it coming. If you ask me to describe myself, that's me. A lemming with a life vest. That's all I aspire to be. You know what? It's very difficult to not feel the mood of the moment. If everybody's feeling upbeat and buying, if you're human, you feel like buying too. If everybody's panicking and selling, you feel like selling too. All that valuation does, it throws a life vest to me. It says, well, even if everybody else changes their mind on the stock, you've got the cash flows to hold on to. That's why I do valuation. It's not going to make me rational. I'm human. A rational human being is an oxymoron. We're programmed to be irrational. All this does is slow the process down, give my rational side a chance to mount an argument, and maybe 1 time out of 10 when I listen to it, I can do the right thing. So think of this class as getting that life vest. It's not going to make you rational, but it'll at least give your rational side a chance to mount an argument. So that lead, and let's talk about 3 very broadly held misconceptions about valuation. Widely held even among people who do valuation for a living. The first is related to the start of the class today about bias. There's this misconception that valuation is some objective search for the truth. You know what feeds into this? We sit in front of computers with Excel spreadsheets, we enter numbers, and then we convince ourselves, I'm being objective, I'm just using numbers. That's an absolute lie. All valuations are biased. The only question is, in which direction and how much? I'll give you an example. I valued Microsoft every year since 1986. Between 1986 and 2014, every time I valued Microsoft, I found it to be overvalued. You name the price, overvalued at $2, $4, $6, $8, $10, which is weird because one of the great stocks of the 20th century, I wouldn't have touched it one step of the way. Now, I could give you access to every single Microsoft valuation I've done over the last, between 1986 and we'll talk about what happened in 2014, 1986 and 2014. You could go through every valuation line item by line item looking for why I found Microsoft to be overvalued, but you'd be looking in the wrong place. If you really want to know why I found Microsoft to be overvalued, if you get a chance, come to my office. 969, the door's usually open, walk in. Here's what you're going to see. You'll see a MacBook Pro. To my left, I have an Apple display. And my iPhone, my iPad, I've got my, Apple, earbuds, AirBuds, whatever they are. I've been an Apple user since 1981. In fact, if you stay in my office and look up towards the ceiling, on the very top shelf, I have my first Mac 128K. Those of you who've never seen this, this is the original Mac, which came without a hard drive. How the hell did you save a file? Here's what you had to do. You had to put the program disk into it was this floppy disk. You put that in. You typed your document, please God, nothing bad should happen. And then you popped out the program disk and put in another disk, hoping again, nothing awful would happen. You'd save there was no hard drive. And to me, Microsoft has always been the Darth Vader of technology. For those of you who are Star Wars fans, let me be very specific about which Darth Vader I'm talking about. I'm not talking episodes 1, 2, 3. Not Anakin Skywalker, cute little Darth Vader. I'm talking episodes 4, 5, and 6. Dressed in black, never takes a shower. Have you ever wondered how does Darth Vader ever take a shower? I have terrible thoughts about Microsoft and awful thoughts about Bill Gates, which have nothing to do with vaccines. And you know what? Every time I sat down to value Microsoft, it bubble up to the surface. Because in valuation, you constantly come to forks in the road, right? High growth or low growth? Who buy this rotten product? Low growth. High risk or low risk? One virus away from blowing up. High risk. And by the time I make my choices, come up with a low value. To complete the story, so what happened in 2014? I started to feel sorry for Microsoft. Because by 2013, it had lost the battle, right? Apple ruled the world. Microsoft's a two-hit wonder. You know what the two hits were? Office and Windows and Office. They had figured out a way to come up with the product that actually made them money in 20-something years. It's very difficult to feel angry at a company that you feel sorry about. I actually bought Microsoft. Some of your best decisions are born for the worst reasons. I bought Microsoft because I felt sorry for the company. Just like I bought Apple as my charitable contribution in 1999. Nothing to do with intrinsic valuation. But between 1986 and 2014, I knew I was far too biased to value Microsoft because I hated the company too much. But there's one other company that I'm far too biased to value, right? That I've given away in the story, which is Apple, because I love the company too much. If you go to my blog, I've actually been valuing Apple since 2009 on my blog. And if you look at the very first blog post I had on Apple, I spent half the post telling people, don't trust me. I love the company. And that's all I can do, right? I can't say, well, I'm going to be objective here and set that to the side. How the heck do you actually do that evaluation? Let's do a very simple test. How many people in this room like Elon Musk? Come on, you can put your hand up. I like Elon Musk. I'll wager that what you think about Elon Musk correlates very highly to what you will find about Tesla. Because Tesla is a company built around a personality. Increasingly, that is starting to affect how Tesla gets priced in the market. It's become, what do you think of Elon Musk? You don't like him, you sell Tesla. You think that is not rational, it's completely rational. And as I said, if you get paid to do evaluation, I can tell you which direction the bias is and how much the bias is. I'll tell you a story to show you how this plays out in practice. So about 30 years ago, a company called Lynn Cable, obviously a cable company, and AT&T had this option to buy 49% of Lynn Cable at an appraised value. So time for the option to be exercised comes about. So AT&T goes out and hires Morgan Stanley. So you guys are going to be Morgan Stanley. What's your job? You're going to assess the value of Lynn so I can buy 49% of Lynn. Lynn Cable goes out and hires Lehman Brothers. I'm sorry to do this to you, but think of yourselves as pre-bankrupt Lehman Brothers. You work for Lynn and your job is to assess the value of the same 49%. So two investment banks go to work and they come back with two very different numbers. One comes back with $105 per share. The other comes back with $155 per share. I want you to guess which side came back with $105 per share. And why? Why does Morgan Stanley come back? Because they work for the buyer. Their job is to come with the low number. And you did your job, you came with a high number. In fact, the difference was so large, they decided to call in a third investment banker. Why settle for 2 fees when you can have 3, I guess? And they call it this outfit called Wasserstein Perella. I'm going to say something incredibly harsh about these guys, but I mean every word of it. These guys could value a $20 bill in a brown paper bag if you put in front of them. They didn't invent a multiple. Enterprise value to cash in the bag, 3.3. Next thing, you're paying $66 for a $20 bill. But if you're Wasserstein Perella, you're caught in the middle, right? You don't want to piss off either side too much. You got to work with both sides. 105, 155. Where's the safest place for you to be? 130, right? They came back with $127.50. I'm going to let you in a little secret in valuation. If you're ever asked to value something, never ever come back with a nice round number. Don't tell me the target price is 40. Tell me it's $38 and 87 cents. It's amazing what that second decimal will do in terms of creating an illusion. You actually know more than you do. It's got the second decimal nailed down. The truth in most valuations is the value gets decided first, the valuation follows. What do you think all those bankers are doing late at night? They're reverse engineering the numbers to come up with the value. The managing director said, I'd like to see $55. They spend 10 hours of work trying to get to 55. Because they come back with 35, you know what the managing director is going to say, go back and look at the numbers again, look at them over again and again until you get to 55. Why do we waste our time doing valuations? What is our gut feeling? 55, let's stay with 55. Second misconception, if I do a good valuation, I'm going to get the right answer. When does this get started? You do things right, you get the right answer. For me, it got started in first grade. Maybe even kindergarten. Teacher means problem in front of you, 2 plus 3. You get 5. Pats on the back, congratulations. You get any other answer. You got the wrong answer, you must have done something wrong. And this gets drummed into you, right? You do things you got right, you get the right answer. If you got the wrong answer, you must have done something wrong. And God help you if you become an engineer or a scientist, because it gets reinforced further and further. And then you come to this class, you pick a company to value. And you bring that same lesson. If I do things right, I'm going to get the right value. It's not going to work. I'll give you a very simple example of how different companies, you're going to be wrong. The question is how wrong you're going to be. So in 2019, March or April, in 1 week, 2 companies went public. It's a big IPO period. 2 companies, both had names that start with L. The first was Lyft. Lyft went public before Uber did. It was the first ride-sharing company to go public. So think about what Lyft looked like. Public offering, ride-sharing company, money losing, high growth. Nobody was quite sure how ride-sharing was going to play out. The other company that went public in the same week was a company called Levi Strauss. Levi Strauss had been a public company in the 20th century, went back private, was going back public. So here's my first question. It's an easy one. Levi Strauss left. Valuing both companies. Which of these 2 companies are you going to value more precisely? Is it going to be easier to value? Yeah.
Levi Strauss.
And what is it about Levi Strauss that makes it easier to value?
It's more solid and.
You have 100 years of history. You know exactly how it makes money, right? If you forget, you just turn and look in the mirror and back of your pants and you've got Levi's on 501s. It still makes money. It's business model. You have a lot of history. So if I judged valuations based on precision, the Levi Strauss valuation is always going to be more precise than the Lyft valuation. Because look, there are too many unknowns, lots of things can go wrong. But if I ask you which of these 2 companies will you get a bigger payoff from doing valuation, let's rethink that question. Why is it, what is it about? What is it about? Levi Strauss was easy to value. So how come you're not getting a payoff from valuing? Because everybody else has exactly the same ammunition that you do. 100 years of history, they're not. So everybody can value. ChatGPT could probably value Levi Strauss and come up with a number like yours. Whereas with Lyft, most people give up. The payoff to doing valuation is greatest when you feel that feeling in your stomach, oh, I have no idea what's going on. This is out of my control. That's exactly the kind of company with the payoff to doing valuation is greatest. That's why when you know, even the last couple of days, I've had people ask me, is this a good company to value? Because implicit there is a question of where will I be able to get more precise valuations? And I can tell you up front, you pick a money-making company with a long history and an established business model, you get a more precise valuation than you pick a money-losing company. I'm not going to grade you based on precision of valuation. I'm going to grade you on how well you try to get over the challenges I have to grade you based on the company value, not on the precision of valuations across companies. We're going to talk a lot about uncertainty in this class, and we're going to talk about how to deal with uncertainty. It's a feature, not a bug. I mean, often when people do analysis, they try to make uncertainty go away. How can I make it? You can't, it's part of life. What we have to come up with is healthier ways of dealing with uncertainty. And as we go through these valuations, we'll talk about what am I most uncertain about and how do I at least deal with that in a healthy way. Third misconception, if I make my model bigger, it's going to get better. Three statement models, right? You open up an investment banking valuation model. I told you you can value a company and you can use my spreadsheet. I'll tell you what you cannot use. You worked in investment banking the last summer. For your sake, don't use that model. Not only will it do a horrific job valuing the company, but I will have no patience to go through 10 worksheets and 5,000 line items to figure out what exactly you're doing. Because here's what happens when you make your model bigger. Inputs come in, they never leave. You start with 12 inputs. How nice to add. And before you know it, you get 90 inputs to value one company. 900 inputs to value one company. Two things happen. One is the model becomes a black box. Right? You feed the input, something happens in the middle, value pops up. I still remember an equity research report from JP Morgan in the early 90s. The equity research analyst put a buy on a company I was familiar with, valued at $80, stock was trading at 35. He happened to be a student of mine from 5 years prior. So I called him and said, what do you like about this company? Why do you think it's worth so much? He said, I didn't do it. So what do you mean you didn't do it? Your name's on the report, it says buy. He said, I didn't do it. I said, who did this? He said, ValueMac did this. I said, who the heck is ValueMac? He said, it's our in-house valuation model. So what did you do? Creep into your office in the middle of the night, value the company and leave it on your desk? But you know what he was trying to say, right? Don't blame me. I work for the model. And there is a point where the model starts to run you rather than you running the model. So if you use my spreadsheet, do it with you running the model rather than, I don't want, in your final report, the Bermuda model value the company at $55. That's 3 points off right there. You want to use my spreadsheet, by all means do so, but take ownership. It's just an Excel spreadsheet. The inputs are yours, the valuation is yours. Becomes a black box. And there's no accountability there, right? Models don't value companies, you do. A follow-up to that? The physical science is a principle called the principle of parsimony. You know what that is, right? If something happens, a physical phenomenon, if you try to explain it, the idea is you start with the simplest explanation for it before you make yourself Einstein and create new dimensions. We have to have a similar principle in valuation. If you can value something with 3 inputs, don't use 5. If you can value something with 3 years of forecast, don't do 10. Because you can mangle some really simple assets using complex models. I'll give you my favorite example. It's on every balance sheet of every company. Simplest of all assets to value. What am I talking about? Cash. You'd be amazed at how many emails I get every week from people saying, I built a model to value cash. Can you take a look at it? I don't even take a look at it. I programmed it, my F7 key, I hit it, says, can you try counting it? Because here's what happens when you build a model to value cash. You take the cash, help me out here. You project the income on the cash. If it's cash in a US or European company, what has to be true about where it's invested? It's got to be invested in something liquid and riskless or close to riskless, which is either T-bills or commercial paper. So take it in 2020. You have $10 billion in cash, or even take 2024. You have $10 billion in cash, and you invest in T-bills. What are you going to make on those T-bills right now? Does anybody know what the T-bill rate is? It's about 5%. So you project out 5% income every year. At that point, all is lost, because once you project your income, the Pavlovian response, and you go to business school to acquire, kicks in, which is, if you've got projected numbers, you need to discount them. To discount them, what do you need? A discount rate. You say, great, I went to Stern, I can estimate betas and cost of equity and cost of capital. You come up with a 9% cost of capital of the company. You're patting yourself on the back so hard, you're hurting yourself. And then you discount the income back at 9. What happens if you take 10 billion in cash, earning 5% and discount that income back at 9%? You'll wipe out 2 billion. Amazing how you could wipe out. It happens all the time in discounted cash flow models. People discount income from riskless or close to riskless assets at this risk-adjusted number, you violate a first principle evaluation. So less is more. Keep it simple. You're going to see me build complex, but my question with detail is, do I need it? Is there something I can add by adding a layer of detail? If the answer is no, don't do it. I've never broken working capital down into constituent items ever in my life. Change in working capital affects cash flows. I've never looked at inventory, receivables, payables. You know why? Because I'm incapable of forecasting days of receivables for the next 20 years. I'm in awe if you can do that. But if you cannot do that, why break things down when you're bringing nothing to the table? You've heard of the Bermuda Triangle? This is a mythical area in the Atlantic where ships and planes go to disappear. There's a Bermuda Triangle evaluation where you've got three sides of the triangle. You've got bias, you've got uncertainty, you've got complexity. And in the Bermuda Triangle, good sense disappears. We spent so much time talking about the metrics and models and the tools and models and how to estimate discount rates. We really should be having a more honest discussion about bias and uncertainty and complexity, because that's where real mistakes in valuation get made. So what I'm going to do is at least set the table in this class for what's coming in the rest of the class. You hear people say there are hundreds of ways to value companies. Not true. There are only three ways, and only three. So absolutely only three ways you can put a number on an answer. One is you can do an intrinsic valuation. You estimate the cash flows, the growth, the risk, try to put it maybe in a discounted cash flow model, maybe not. That's it. The second is you can price it by looking at what other people are paying for similar things. And if you have an asset that is a contingent cash flow, in other words, something has to happen, FDA approval has to happen, you can use option pricing. You take every valuation model out there, it's got to fall into one of these three buckets. So I'd like to at least set the table for each of the three buckets. Let's start with intrinsic valuation. The core idea in intrinsic valuation was set on your very first day of your very first finance class. Remember that class? I know you've been trying to forget that class very hard. When I took my first finance class, one of the things we were required to do was buy a financial calculator before we showed up for class. You know what? To teach us the meaning of a sunk cost, I think. Because this way, if you came to the first class and said, I don't want to take this class, I want to drop the class, your professors respond, that's fine, but they won't take the calculator back. But you've learned a very important financial lesson for the rest of your life about sunk costs. And during the course of the class, you start wearing out the present value button. If any of you have physical calculators, very few of you still do, take a look at the calculator. The PV is completely worn out. There are all these virgin buttons on the calculator you've never touched. That ln x, you say, what the heck is that? I don't know. The e raised to the power x, I don't go there either. It's amazing how much of finance is present value. Intrinsic valuation is an extension of the present value lesson. The value of an asset is the present value of the expected cash flow of the asset. But before you dig into intrinsic valuation, remember, with all of these approaches, you are making assumptions about how markets work, and they don't work. In other words, if you believe markets were completely efficient, you know how long this class should last? At least for publicly traded companies? What's the value of Apple? Open the newspaper or look it up online, but the price is the market price is the value. So implicitly, when you do valuation pricing, you're already telling me markets make mistakes. Now we can debate whether that's true or not, but you're also making different assumptions about what types of mistakes market make, and we'll be explicit about that, and how those mistakes get corrected. Don't forget that second half. If mistakes never get corrected, who cares if markets make mistakes? So intrinsic valuation, basically you're starting with this very simple statement. The value of an asset is the present value of the expected cash flows of the asset. You're also starting with the belief that every asset that generates cash flows has an intrinsic value. You know how many analysts argue with me? They said there's no such thing as intrinsic value. I firmly believe there is an intrinsic value for every cash flow generating asset. I also firmly believe that I will never get to see it. It's like a little bit like the search for the Holy Grail. How long have people been searching for the Holy Grail? 2,000 years. I think Indiana Jones came a little close in one of his movies, but nobody's ever found it, right? But we keep looking and looking. Intrinsic value is very simple. There is an intrinsic value. We'll never get to see it, but we keep the faith, we keep trying. And if you break down an intrinsic valuation model down, no matter how complex it is, here are the three ingredients you're going to see. You're going to see cash flows. Whether it took you 50 line items or 500 line items, the bottom line is cash flows. You'll see a discount rate, whether you use the CAPM, the arbitrage pricing model, multi-factor model, it doesn't matter. There's a discount rate and there's a life for the asset. You remember what Archimedes said, right? If you give me a lever long enough, I can move the wood. You give me cash flows, discount rates, and the life of the asset, I can value just about anything. And that's going to be the core idea that drives how we think about value, is to convert. If I ask you, what is Shoei Atani's contract worth? Somebody help me out here. What are the cash flows?
Most of it's like after 10 years.
It's for 2 million a year for 10 years. Like 690 at the end of the 10 year. Why? For tax reasons, for contract reasons. Can I value the contract? Absolutely. I'd have to discount it, right? So what's the risk in those cash flows? But the Dodgers could go bankrupt. I keep hoping and praying that will happen. But the risk is default risk, right? This is not a cost of equity. It's not like it's a profit sharing agreement. So if I ask to value the contract, I'll take the cash flows, I'll apply a discount rate that reflects the default risk in the Dodgers, and it's actually quantifiable, and I'll come up with the present value contract. Cash flows, discount rates, life of the asset. But remember, when doing all of this, your end game is you want to try to make money on your valuations. It's different if you work and your job is to do valuation, but if you're valuing companies as an investor, so let's see what has to hold for you to actually make money in your valuations. First, you have to assume that markets make mistakes. You know what? You won't find a single person in the world who would disagree on this. Even the firmest believer in efficient markets will agree with you on that. Gene Farmer won a Nobel Prize for all of his work in efficient markets. The markets make mistakes, they make some real doozies. That's an easy one. Second, you have to assume you can find those mistakes with your metrics and models. Now we're on dangerous ground. Why is that? What is the track record of people who claim to find market mistakes?
They don't beat the S&P from.
It's worse than that. Not that they don't beat it. They actually are underperforming. The average active money manager underperforms the S&P 500 by 1.5% every year. It's the strangest profession. I mean, and the analogy would be like my starting a plumbing business called Floods Are Us. And here's what I do. You have a leak in your house, you call me and I leave a flood. And I bill you for it. Look, I left a big flood. But let's say you're special. You found a metric that actually works. Let's give the mistake a name. Let's pick Tesla. It's had a rough few months. It's at $215, $210. You valued it 300. Let's say you're right. It should really be at 300. So markets make mistakes. You found the mistake, right? What's the third thing that has to happen for you to make money? Markets have to correct the mistakes. And how the heck do you make that happen? So I'll go on Facebook and post, Tesla is cheap, Tesla is cheap, Tesla is cheap. You know what? 1 million people post all the time. Nobody listens to you. So the third leg is out of your control. The only consolation price I can give you is the longer your time horizon, the greater the chance that if you're right, the market mistake will correct. No guarantees even there. Already you can see the ingredient you need to use intrinsic valuation. Now we're going to talk about how I can't think of a single portfolio manager of any size who uses intrinsic valuation to run their portfolio. Not a single one. And part of the answer is here, right? How portfolio managers judge? They've judged against how well or badly they've done relative to other portfolio managers like over the last 6 months or last year. If you don't have a long enough time horizon for market mistakes to correct themselves, you can't, even if you're right about intrinsic valuation, you can't wait long enough to gain that profit. So let's talk about the advantages of intrinsic valuation. How many people in this room have read a Warren Buffett book? Really? Page 1 all the way through? That's good. Or is it like security? Now, most people who claim to read security analysis read the title, maybe the preface, leaves through the book very quickly. I've read security. It's like a religious thing, right? You have to say, I've read security analysis, because that makes you. No. But one of the I mean, there are points in which I disagree with Warren Buffett. I said that those of you pray to him and he's godlike, and take that for whatever it's worth. But there's one thing he says that I think explains what intrinsic valuation is all about. He says, I don't buy shares in a company, I buy a piece of a business. Intrinsic valuation, that's effectively what you're doing. You're saying, I'm buying a piece of a business. I don't care what other people think about it. I'm going to see what that piece is. And second, it forces you to understand the business, right? You cannot do good intrinsic valuation without understanding what drives the business, how a company makes. If you don't understand how Airbnb makes money, how does Airbnb make money? Somebody help me out. How does it make money?
How they collect the.
They're an intermediate, right? So I rent an Airbnb, they don't own the apartment, but they collect, do you know how much they collect? 14%, right? So if you pay $500 for an Airbnb, 14% goes to Airbnb. I need to know that to understand the business model to be able to value Airbnb, because it's going to tell me the strengths and weaknesses of the model. It forces you to understand the business. And to the extent that you buy a business because you like its cash flows, at least in theory, you should be completely insulated from what the stock price does, right? Because why do you buy the business? To collect the cash flows. You don't care if the stock price goes to 5. The reason I said in theory is in practice, it's very difficult to put those blinders on. But in theory, if you're truly an intrinsic value person, you buy the stock, you collect the cash flows, and you're okay even if everybody else thinks you're a fool. Now, what are the disadvantages? It requires a lot more work to do a valuation than a pricing. You need to understand the business, you need to tell a story, convert those cash flows, And you could be wrong. That noisy is a word you're going to see me use repeatedly. Basically, it's a way of saying there are errors in your estimates of the growth and the cash flows. Noise, you can live with. Bias, you cannot, because a bad discounted cash flow valuation is one where you're not just wrong on the inputs, you're biased on the inputs. So you can screw. So, I have a DCF hall of shame I've created, where I collect really bad DCFs. I give them names, like Trojan horse DCF. I will go through some of the bad DCF. Now, basically, it's DCFs that basically look like discounted cash flow valuation, but really do a horrible job. Okay. And finally, remember, when you do intrinsic valuation, it is entirely possible that everything in a sector comes out as overvalued. You think so what? Many equity investors, especially portfolio managers, have sector requirements. They have to buy social media companies, AI companies, tech companies. This might be incompatible with your mission. Because in intrinsic valuation, you could look at every bank and say, all banks look overvalued. It's entirely possible. So here's when discounted cash flow valuation is easiest to use. And think whether these conditions get met, because we sell people on discounted cash flow valuation is good, pricing is bad. I think that's a terrible piece of advice, because it depends on who you are, what your end game is, what you're trying to do. Yeah. Discounted cash flow valuation first works only if you have assets with cash flows. I kind of mentioned this, but if you ask me to do a discounted cash flow valuation to value Bitcoin, I can't do it. Bitcoin is a currency. Currencies don't create cash flows. So when I'm looking at currencies, collectibles, a Picasso, even gold, and we'll talk about gold as a special commodity that acts like a collectible, you can't do valuation. But if you think in terms of what kinds of investors are best suited for discounted cash flow valuation, first, we talked about time horizon, long time horizon. And here, you've got to give Buffett a benefit that he's had that most portfolio managers don't. For much of the last 3 decades, what money has Buffett been investing? Berkshire Hathaway is the company, and we're going to take a deeper look at Berkshire Hathaway.
It's float.
Where does the capital come from? from the insurance operation. So Geico goes out and sells life insurance, it collects premiums. That capital, so every insurance company has its advantage. On one side, you're an insurance company, the other side, you have a closed mutual fund. Most insurance companies, that closed mutual fund is run by a very average mutual fund manager. In the case of Berkshire Hathaway, you've had the greatest mutual fund manager of all time. But you know the great thing about investing insurance company capital is? What determines the cash flows of an insurance company?
Well, a lot of it is like long dated life
It's
insurance.
actuarial, right? The actuarial tables don't panic on you. Remember November 2008, most of you were kids then, you don't remember, but it was a horrifically scary time. Lehman had collapsed, and there was talk that Morgan Stanley was next in the list, and Goldman was going to follow. The prices for all these investment banks got pushed up. In November 2008, Warren Buffett of Berkshire Hathaway made two investments, one in Bank of America and one in Goldman Sachs, at incredibly low prices. No portfolio manager could have done that, because if they'd done that, their clients would say, what are you doing buying an investment bank in the middle of a crisis? But you're investing in insurance company capital, the actuarial table said, go ahead, we don't need you for 11 years. Everybody claims to have a long time horizon, but make sure you really do, because that's one of the first ingredients. Second, it'd be nice if you can be the catalyst that causes the market mistake to be correct. Okay, this means I have to have more social media, maybe if I have Mr. Beast on YouTube pushing, how many, like 125 million followers. Biggest investing celebrities have YouTube accounts with lots of followers. That's not the kind of catalyst I'm talking about. But Bill Ackman and Carl Icahn find something to be undervalued, and they take a position. What's the first thing that they both do? They get on CNBC and they make it public that they've taken the position, in effect, trying to push other people to that it's nice to be a catalyst. But to be a catalyst, you need a couple of billion, 3 billion. If you have that, good luck. And if not, don't even try, right? If you have 100,000, I'm going to be the catalyst in Apple. $2.5 trillion company. Nobody's even looking at it. And finally, this is something that's psychological. The nature of intrinsic valuation is often buying things that other people don't like when everybody's down on it, and selling things when everybody's excited. You're going against the crowd. Let me ask you a question. Go back to your days in kindergarten, first grade. Were you the kind of kid who marched to your own drummer, or were you wanting to? I'm not saying this in a good or a bad way. Each of us has some degree of need to be part of a peer group. If you're the kind of person who's easily swayed by the people around you, intrinsic valuation is not going to work for you. Not because you can't value companies, but because you will not be able to hold on. So I'll give that to you as your assignment for this weekend, is to think about, do I have a long time horizon? Do I care about peer pressure? Because that's going to give you a sense of, hey, how much will I be willing to actively participate? One more final thing, I will put out a master list link later today with all of your names in it. And I'd like you to start entering the names of your companies as you pick them. You can go back and change them if you want, but enter the names. I think I can get a sense of how we'll move it.